Good afternoon, good morning, and good evening, everyone. Thank you for joining our very first Future of Financial Information webinar series. And so there's one good thing to come out of the current situation is that people are more willing to participate in this sort of online events. And research was always a global business, but it feels like nowadays it's even easier to get in touch and communicate with anyone wherever they are. So I really hope that we can use these webinars and also similarly titled conference that's going to happen at the end of May to build a community of researchers interested in financial information and related topics. So today we will have Nataliya Gerasimova from the Norwegian School of Economics presenting her paper, House of Funds. So before we begin, just a couple of housekeeping rules. So the format will be 30 minutes presentation, 15 minutes discussion, and 15 minutes Q&A. So the idea is to defer the questions to the Q&A. So if you get a question during Nataliya's talk, please submit it to the chat. So what I'm showing you right now is where you find the chat if you're on a laptop or a PC. So you should see it down in these meeting controls, the chat icon. And just type your question there. I have a question is perfectly sufficient, and then we will call on you at the end in the last 15 minutes. If you want to be super nice, you can write a little bit more what your question is about, and then I can try to cluster similar questions together. If you have a pressing, clarifying question during the talk, you can raise your hand. So to do that, you need to click on participants and then raise hand, and then we will interrupt and let you ask your question straight away. So in the interest of the flow of the webinar, please use this option conservatively. So yes, I was going to say that, Nataliya, the screen is yours for 30 minutes.
Thank you. Hello, everyone. So I hope you could see my screen because actually my sound just disappeared. So I didn't hear Michael for the last 2 minutes. So everything is working now?
I think that was my fault, actually. So you're good.
Okay, perfect. So thanks again, Michael, for organizing the seminars and asking me to present and to be the first one. I'm really excited and I hope it will work out in this format. So today I'm going to talk about my paper, House of Funds. And let me start. Just switch here. So during the history, there have been several cases when the politicians were involved in the insider trading. Actually, not even during the last century, like 20th century. The first case of the insider trading was already at the end of the 19th century. 3 politicians were involved into the insider trading of the stocks of the railway companies. And also during the last decade, there were mostly trading. There was mostly insider trading activity. Sorry, Michael, could you not making me a host that I could see now that I admit people to the room? Sorry. Okay. Sorry again. So during the last decades, most of the insider trading was in the industry of the pharmaceutical companies. And also there was a recent case last week, even several weeks ago. One of the senators, like Kelly Loeffler, she was involved into probably insider trading due to the coronavirus briefings. So after she and several other senators received private briefings about the virus, suddenly she decided to sell lots of her individual stocks, and she bought some stocks in the teleworking software, which would help people to work from home. So what was her answer? Last week, she wrote an open letter to Wall Street Journal, where she mentioned that now she would like to get rid of her all individual stocks and just to start investing into the ETFs and mutual funds. But is it really an answer? Whether it's a solution to the problem when the politicians start to invest into the mutual funds? So what I'm looking at in my paper, I check whether mutual funds which are connected to the politicians benefit from these connections. How I identify the mutual fund being connected: if a member of the Congress invested into that fund during the given year, then I see that fund as being connected to the politicians. Also, I particularly focus on the politically sensitive stocks. So these stocks coming from the energy industry, pharmaceutical industry, they're particularly sensitive to the legislation process. And I have 3 questions. The first one, whether funds connected to the politicians tend to overweight these types of stocks. The second one would be whether they trade this type of stocks more actively, and if it is the case, whether there exists a strategy which brings abnormal returns when mutual fund managers trade on the politically sensitive stocks. The answer, of course, yes, indeed it is the case. They tend to trade them more actively. They also overweight the positions in politically sensitive stocks relative to the non-connected peers. And there is a portfolio which goes long into politically connected stocks of the politically sensitive stocks of the connected funds and short all the rest of the stocks, then this portfolio would bring abnormal return after controlling for the farmer fringe factors. And one of the cases as well in the history, it was already 2008, there was a Senator Mark Udall. He was simultaneously sitting at the Energy Committee and also was investing into the mutual funds, and that mutual funds were investing into the clean energy stocks. Also, besides doing that simultaneously, before becoming a senator, he was campaigning and supporting these types of businesses. It's really hard to say whether there's indeed inside information trading or whether he just supports these companies by investing into them, but still there was social stigma and attention that why is he doing that when he's influential politician, if he supports these companies, he also holds the stocks, he knows that he could get probably higher returns in the future. So my paper mostly contributes to 3 strands of the literature. The first one would be mutual funds and their outside connections. One of the first papers was the paper by Ritter and Jung, in which they show that if mutual funds deal with investment banks, and these investment banks are leading underwriters for some firms, then these banks tend to allocate hot IPOs to their mutual fund clients. So there are not really Chinese walls between these 2 types of businesses. Also, mutual funds could belong to the families of the banks, so they would have the same affiliation, and banks, of course, provide loans to the firms. Then these firms, being the borrowers of the bank, need to provide information about their current situation. And then the bankers tend to share this information with the mutual fund managers. The last example for this papers would be that if a mutual fund manager was going to the same school with the CEO of a company, the same university, then the CEO of that company has a connection, and going like social networking might share information, inside information with a mutual fund manager. So what differs in my paper, that I don't really look at this inside information generated inside of the company, I look at the outside the information. So this type of information is generated at the Congress, so during the legislative process. And this type of information most likely is going to affect the whole industry, not necessarily in the same case that all the firms would be affected equally, but still it's not a shock or information about some particular firm. Then the second strand of the literature would be directly holdings of the politicians. Most of the papers look at their stock holdings. If as a politician I invest into a company, then it seems that these companies tend to get more government contracts. Usually government contract is highly competitive environment, it's not easy to get them, and it's kind of like a good signal. Moreover, besides when you get the government contract, it also reduces your pressure on even borrowing from the private sector. Anyway, it's a good signal. So these types of the companies get the more contracts. Also, the probability of the default or the probability of the bankruptcy is decreasing for these companies, and the probability of bailout is going up. What's different for me, I think to my knowledge, is the only paper which looks at the mutual fund holdings, and I don't take a perspective of politician. I look where the mutual fund manager is going to benefit from the connection, not the politician. Also, the last strand of the literature looks at the mutual fund managers and hedge fund managers' political behavior, especially the first two papers that go more into the behavioral strand. So they check whether the mutual fund manager who is going to contribute more during the campaign contribution during the campaigns to the Republicans, whether the stock holdings, the portfolio of these mutual fund managers would be different from the ones which would contribute to the Democrats. And indeed, it is the case. So what they find out that if a mutual fund manager contributes more to the Republican, then they tend to hold more tobacco or energy stocks. The closest paper to mine would be the paper by Gao and Huang. So it's called Capitalizing on Capitol Hill. What they do there, they look at the hedge fund managers, at their lobbying activity. So whether higher lobbying activity, higher lobbying expenses lead to higher abnormal returns in politically sensitive stocks. And they found that indeed it would be the case. What's different from my paper, that first of all, I look at the mutual fund managers, and compared to the hedge fund managers, mutual funds also need to disclose their long holdings. However, hedge funds don't need to disclose their short positions. And by focusing on the mutual funds, I'm able to observe the whole portfolio instead of just a part of it. Moreover, because I'm not looking at the lobbying, I don't have this lobbyist, a middleman. I look at the direct link between manager and politician. And also, due to the current regulations, you don't really observe to which each manager, which politician he or she would lobby. It's just the aggregate amount of lobbying activity per fund. And so talking about this, let me talk a bit about the data, how I use this direct holdings of the politicians, and in particular the mutual funds, and whether they need to disclose it and why. So since the middle of the middle of the 70s, they need to disclose their holdings they provided to the Center of the Responsive Politics by the 15th of May. Then the workers at that center, they need to classify these types of stocks as holdings as stocks, bonds, mutual funds, and other private holdings. So again, my focus would be the mutual funds. They don't really need to disclose the exact amount, how much they invest into each fund. What they need to do, they just need to disclose the interval. For example, for each individual politician, if you invest more than $15 million, which is not really so often the case, then you just say above that amount. They also need to disclose the holdings of their spouses and children. For example, if a husband of some politician invests more than 1 million, as well, it would be there is no limit on that. Anyway, if either politician or a member of that family is investing into a mutual fund, I consider that this fund is being connected to politicians. Also, when they disclose the name of the fund, they don't really need to disclose what would be the holdings of that fund. So in order to be able to classify stocks as being politically sensitive or not, I also need to merge this non-standard open source with a standard database. So I take the S12 holdings, I run textual merge procedure, and I'm able to identify a bit more than 500 active mutual funds, and then I look at their holdings. Also, besides just looking at the holdings, I also need to control for their characteristics. That's why I use CRISP mutual funds in order to be able to be sure that my funds don't differ from the rest of the sample. And then, besides telling to you that they trade them more actively, these stocks, and they also tend to overweight them, I also need to check whether there is some strategy which would indeed bring some abnormal return. So in order to do this, I also merge my data set with a CRISP, and that's how I compute the calendar returns for my portfolios. And in order to control for the characteristics of the stocks, that it's not just driven by the size or book to value, I also merge with the composite characteristics of the firms. Just to motivate a bit more and to show you that it's not driven by one or two politicians investing in 2 or 3 funds. It's indeed mutual funds is a big portion of the portfolios. It's converging after 2007, as you could see on the graph, with the stocks holdings. It would be second popular after the stocks. What I need to add here that some growth in that picture is also driven by the passive mutual funds. In my analysis, I focus only on the active ones. But still, even if I focus only on the active ones, I'm able to show that on average 20% of the holdings would be in this type of funds, and more than half of politicians would, Congress members would at least hold 10% of their holdings in mutual funds. What I also do, I look at the funds which were connected at least once. So at least once during my sample, 1 quarter should be that one of the politicians or members of their families invested into that fund. And I'm able to identify slightly more than 600 funds, and among the database of these politicians in open source Center of the Responsive Politics, I'm able to identify more than half of them actually invest into the mutual funds. Then the unit of the observation would be fund stock quarter. So then I would have more than almost 3 million of these observations. And again, what are the current stage I have, that even if the several politicians would invest into the same fund, I would just have a dummy of 1. So right now, I don't look exactly to which politicians they're connected. I just see whether there is at least 1 politician as a retail client of that fund. So besides besides being looking only at the political sensitive stocks, I look at the second channel. I also look at the committees. So the committees could have particular jurisdictions. Of course, there are more than 6 committees in the Congress, but I look only at that ones which were previously identified in the literature, would be easy to connect to some particular industries. So for example, agricultural committee, if a politician is sitting at the agricultural committee, probably he or she has more information about this industry, also going to propose and sponsor more bills, and so to say, has more influence for exactly that type of the industry. And then I look at the funds. Let's say a fund manager as an investor has a politician who is sitting at the agricultural committee. Then I go to a portfolio of that fund and I classify the stocks as being connected. Agricultural stocks would be connected, all the rest would be not connected. The next, again, as I was talking about, that's mostly politically sensitive ones. As you could notice, there's also some intersection. Some types of stocks could be simultaneously politically sensitive and also with the particular jurisdictions. That would play some role, I believe, in the results later. Again, to show you how I classify the stocks. Okay, there is a fund. The first step would be to see whether a Congress member invests into that fund. If a Congress member invested into that fund, I say, okay, that fund is being connected. The second step would be to see whether a fund connected to the politician holds more politically sensitive stocks. So the stocks connected to Congress, stocks non-connected to Congress. If you're a politician, you could, at the House, you could sit at some committees, you might not sit at these committees with particular jurisdiction. So then I classify, I look at which particular committees they sit. Again, if it's an agricultural committee, then I look again at the portfolio of that mutual fund manager connected to that politician and classify these stocks being agricultural or not. So that's how I got the stocks connected to committees and stocks not connected to the committees. Going a bit more into the details of my results, the first test was that I check whether the politicians tend to overweight, the mutual fund managers tend to overweight these politically sensitive stocks, in which I assume they might have some either information from the politician, or they might think that if politicians invest into them, it's a good signal. I'm going to talk about these channels later after the results. Anyway, I check whether the politically sensitive stocks, whether they overweight them more relative to the non-connected peers. And then the second one would be, I look at each particular committee and I see whether agricultural stocks would be overweighted by the managers which are connected to the politicians who sit in the agricultural committee. The same would be, of course, for the natural resources or any other of the 6 committees. What I find that indeed politicians, if the politicians invest into the mutual funds, then these mutual fund managers tend to overweight these politically sensitive stocks. They tend to put more assets under management into them by 9% relative to their non-connected peers. If you look at the committees, then the results are slightly mixed. The most strongest one, as you could see, would be for the energy, commerce, and natural resources. As I mentioned before, there could be the effect that because this is simultaneously politically sensitive industry and also with a clear jurisdictions. So that could be that could multiply the effect. Whatever I do, whatever I run for this, there's always a kind of an issue with the transportation committee. It's the opposite result. So this is in a way an outlier in my data. There could be several reasons. One of the reasons would be that actually transportation industry is also highly regulated at the state level. So maybe when I look at the federal one, I miss some connections. And moreover, also it's highly sensitive to the campaign contribution and lobbying activity. So it's one of the sectors which has high portions of both. And again, currently what I do, I look only at the direct holdings. So I don't pay attention now whether there could be some managers connected to the transportation stocks through the campaign contributions. Also, that was just a mean analysis, and if I run the regression, on the left-hand side there would be still the weights. On the right-hand side, the most important variable would be connected. If I'm being connected, it means that at least one politician invested into that fund, it would be 1. Then I control for the fund and stock characteristics, and I also have fund and quarter fixed effects. So even after controlling for that, I still find the positive result that indeed, if a manager is connected to a politician, he or she are going to invest more into politically sensitive stocks. So what would be the next one? Would be to look at the trading volume, whether the trading volume also has, whether the trading volume is higher, the activity, and it's also the case for the politically sensitive stocks, and the same story would go for the energy, commerce, and natural resources. Indeed, if mutual fund managers tend to overweight these stocks and they have some private information, you would expect them to trade more actively. So the last analysis would be where I look at whether there is this strategy. I form the calendar portfolios. I look at the mutual fund being connected to the politician. I find the politically sensitive stocks in his or her strategy, and then I long this type of stocks. Then the second step would be to short all the rest of the stocks. So to short the stocks of the non-connected funds and to short the stocks of not politically sensitive stocks of the connected funds. Then depending on the benchmark, if I use either only market factor or 3-factor FOMO range, as you could see, there are abnormal returns for this type of the strategy, like 75 basis points for the politically sensitive stocks. For the stocks in the committees, it would be the case, but it's not significantly different at 10%. So there, what I mean that the coefficients are of the right sign, but however they're not significant. So the most effect is coming for the politically sensitive stocks. So I guess I have now more or less 5 minutes. I would like to talk more about the channels. So when I've started to write this paper, I was thinking about the first channel is information leakage. So just because I'm a politician, I'm interested in doing well in terms of my portfolio investments. So I have some particular information. Why wouldn't I share it? So I call it explicit flow. There have economic incentives for the legislators to share with the fund managers. What goes a bit against that channel, that actually it's illegal practice after 2012. What I have now, only the data until 2013, so I don't have this diff and diff setting yet to check what's happening afterwards. What could be the case actually, that because the politicians don't want anymore to be accused in the insider trading, they stop to invest directly into the stocks and they start to invest into the mutual funds, but still they might share some information with the managers. And that was actually not, I don't say that that senator last week who was related to the inside, potentially related to the insider trading due to the COVID information, but still she said, I'm going to switch to mutual funds. What's going to happen there? I don't really know. But there could be also the second channel, the signaling. So this is indirect channel, it's implicit flow of information. As a manager, I see that the politician invests into my fund, and then I see that this politician is, let's say, again, sitting at the agricultural committee. If he or she is sitting at the agricultural committee, I start to buy more agricultural stocks. If a politician does not disinvest from me, I continue this type of the strategy. I also invest as a mutual fund manager to the agricultural stocks. However, if politician disinvest from me, reduces the amount of holdings in the mutual fund, then I think, oh, maybe it's a bad signal. And then I also reduce, being a mutual fund manager, the holdings in the agriculture. So what could be goes against that channel, that not necessarily that all the holdings of the politicians are holdings and also like trading are informative. It could be just to the liquidity reasons. So that's the case that it's hard to distinguish right now. So to conclude, what I find in this paper, that mutual funds connected to the Congress members, they tend to overweight politically sensitive stocks. They trade these types of stocks more actively. There is a strategy which brings abnormal return when you go long politically sensitive stocks of connected funds and short all the rest. And it's significantly different. What I could do next, that right now I don't look at the seniority of the politicians. So what I look at, if any politician invests into a fund, perfect, connected. It's also possible that if I'm a chair of that committee, I have more power to decide which bills are going to be discussed. I also know more private information. So probably connections to that types of politicians might matter more. Also, here I focus on the mutual funds. I've kind of started some analysis on the hedge funds, but to be honest, mutual funds might be a better laboratory because the politicians, as I said before, not so rich, so not all of them are able to invest into the hedge funds. They're just simply not classified. And moreover, the Center of Responsive Politics doesn't need to classify hedge funds as some particular part of the investment. So it goes in the basket with private equity funds and so on and so forth. So then the data is getting even messier than for the mutual funds. What could be also the case, taking into account the networking literature, that besides just trading directly using my information, I could be connected to another politician through sponsoring of bills, so co-sponsoring. So probably when I sit at the agricultural committee and another politician is sitting at the natural resources committee, but we have some bill together which we co-sponsor, so we spend time together, I might share some private information with him. and then he would be able to trade that agricultural stock. So I didn't look yet at that spillovers. Also, what could be the case that probably mutual fund managers might benefit from investing into the companies who just got a government, who are going to get a government contract. As I said in the beginning of the presentation, it's usually a positive signal at the market. So usually the stocks of these companies, the price would go up for them. So it's possible that mutual fund managers could benefit from this type of the strategy if they know that politician is going to give a contract to that fund, to that company, that the fund might buy this company just a few days before. Also, as I said, now I look only at the one layer of network, at the direct connections. I don't really look at the campaign contributions or lobbying activity. So there could be some misclassification, for example, for the financial sector, where I don't see the strong results, because FIRE, it's a financial investment in real estate with the highest contributors. So it's possible that some funds would be connected through that links. What I did actually so far, I still looked at another layer. I looked at the previous employment of the politicians and also at their current connections to the mutual funds, and I didn't find at least the case that they were connected to the portfolio management industry before they got their seats in the Congress. Okay, thank you for your attention, and I'm looking forward for the discussion and questions too. Thank you.
Yes, thank you very much, Nataliya. Spot on time. And today, it's my pleasure to not only be the host, but also the discussant of this paper. So I'm gonna share my own screen right now. Okay, and then take 15 minutes to give some comments on this this very interesting paper. So just a little bit of disclosure. So I'm experimenting with this new approach to discussing papers, and if you are fans of Sherlock Holmes, then I'm sure you recognize these two gentlemen. So this is the one on the right, that's Dr. Jekyll, and the one on the left is Mr. Hyde. So that's what I'm going to put on the Dr. Jekyll's hat on first and say everything that I really like about this paper, and there's a lot to like about this paper. And then I'm going to switch, well, a little bit towards Mr. Hyde and be somewhat critical, although by no means evil. Okay, so starting with my first side. So what I like about this paper, first of all, is the timely topic, and when you think about it, it's sort of always timely. So in the paper, you have examples from 2007, 2008, and in your presentation, you already mentioned what I wanted to mention. That just recently we had more headlines of this sort, that two Republican U.S. senators traded at suspiciously good times just after their briefing on COVID-19, and so. And the background to that, if you're wondering how is that even possible, is these sort of peculiar conflict of interest regulations in the U.S. So there's a big difference between the executive branch, where if you are an employee or a representative of the executive branch, you're actually prohibited under criminal penalty from participating in any official matters in which you also have a financial interest. And so if you're like the Treasury Secretary, for instance, well, that's pretty much everything you do. And so that's why when we had a certain central bank investment banker become Treasury Secretary 3 years ago, he actually had to divest pretty much all his entire portfolio. But that does not apply to members of Congress. For reasons we can speculate about. I mean, maybe because it's the members of Congress who actually make these laws. And so what I think is important, and what I also like about this paper, is I think it's important to highlight the consequences of this kind of sloppy or inconsistent rules. And that sort of, I think, if you want to position your paper in the literature, I think this dark side of finance is also actually pretty good link. Now, the next thing I like about this paper is the careful data work. I mean, Nataliya is very modest about it. So she was saying, okay, I have this data from here, I have this other data from there. But if you ever did empirical work, you know that it's not as simple as it sounds. So great job bringing all these data sets together and crunching it in a way that gives pretty straightforward results that I also like. So first result is that funds connected to Congress overweigh these so-called politically sensitive stocks, which subsequently you call those connected stocks, and are connected to Congress. And then drilling deeper, looking at funds connected to specific committees, you see that they overweigh stocks that fall within the scope of these committees. So you have this group of stocks connected to committees. And then you also find that the funds trade those connected stocks more actively than other stocks, and that a portfolio of connected stocks earns an alpha of about 4% per year over non-connected stocks. And last but not least, I think the mechanism here is also quite intuitive. I mean, most of us would probably find believable that if I'm a politician and I have some information that I could be somehow at least tempted to share this information with fund managers. Right, but that's sort of where we should start to be careful, and that's where I'm also going to start to change my hats. Maybe it's actually too intuitive. Maybe we should step back and flash out all that confirmation bias from our system and sort of take a long look at what is actually shown in the paper. So yeah, I realize that's a controversial choice of words, but I stand by it. So there's no direct evidence anywhere that politicians actually share information with portfolio managers. And seems like you've got this comment before, because at different points in the paper, and not least in the conclusion, you sort of swim around that, making that claim, saying that you provide empirical evidence that supports the hypothesis that mutual funds connect to Congress, place larger bets, trade more actively, and so on. All right, but we don't really know if that's going on, and probably we never will. I mean, given that, I guess under the U.S. system, if anyone, it should be Congress investigating these matters, and we know how being your own judge usually ends. So, I understand that's an easy comment to make, and it's the easiest way to kill any empirical paper. And I can only sympathize with you if that happened to you in the past. But so, I try to think of ways that would actually be helpful and to sort of remedy this problem of endogeneity. And so I think the best you can do is sort of maximize circumstantial evidence for this information channel. So, and just in the presentation, you also spoke about this other channel, the signaling. So I don't have any comments on that, but maybe just now briefly. I mean, the problem there I would see there is that, well, if you really want to take clues from just from the politicians' holdings, you don't necessarily need them to invest in your fund, unless you, I don't know, want to somehow or cater to them. That you see, oh, this person invested, I want to be nice to them, so I will overweight these stocks. I mean, if you think these stocks will outperform, you can always overweight them as a fund manager. You don't need the member of Congress among your investors. So, so I think to me the information leakage is kind of the more intuitive channel, and the question is how you can best substantiate it. And you don't really speak much about this endogeneity problem right now in the paper. I think the word endogeneity appears only once, and perhaps it would maybe be better to sort of tackle this problem head on and see and say what the issues are. And in general, when we think of endogeneity, this can take one of these two forms: reverse causality, so what's causing what, or maybe there's actually a third omitted variable causing both. So let's look at these two in turn. So the way I could imagine reverse causality in this setup is that members of Congress simply pick funds which hold politically sensitive stocks to a greater degree than the average fund. And again, you can speculate why. Maybe because those members of Congress are more familiar with these stocks, so there's some familiarity bias, or they think these stocks will, or actually they think these stocks will do well, but there's no information leakage. They just pick those funds which happen to already invest more heavily into these stocks. And so when I look at your regression setup, which is basically contemporaneous, so it's weight, portfolio weight, and quarter T on connectedness in quarter T. I mean, the simplest version, that's just a dummy variable. So it makes me wonder why. Like, why not use? Why it's contemporaneous? Why not lagged? So because that would actually, I guess, go against reverse causality a bit. If I first get a connection to Congress and then I start overweighing certain stocks, again, that's not definite, but it's circumstantial at least. And maybe it would be even better if you focus on funds that are not connected at all at first, and then become connected. The problem is that some funds are always connected in your sample. Maybe try to kick them out, and then perhaps you could even have a sort of diff and diff setup. So what I'm thinking is that this is time, and that's where you get the connection. So you have some sample of funds that are control sample of funds that don't get a connection, and then another one that do get a connection at zero. Then maybe ideally you would see this kind of jump, and maybe it would even continue going up. So that over here is the weight, portfolio weight. And another direction you could think of is like which funds would be most malleable, meaning most likely or easiest to influence by a member of Congress. Some things that come to my mind are smaller funds, more concentrated funds, both in terms of holdings, but also in terms of investor base. If you're just one of a few investors, it's easier to exert influence. Maybe younger funds. So you use some of these variables, you use some of this stuff as control variables, but what I'm thinking more is like subsamples and see if the effect differs depending on the type of the fund. Or you could also look at it from the other side and think about which members of Congress are most likely to share information, so their characteristics. And maybe I'm too much influenced by these recent events, but maybe the side of the aisle, Democrat versus Republican, could matter here. At least I think Republicans are more likely to be involved in the markets and more likely to invest. Or if you want to be more specific, maybe some measure of activism in the sense of how active are the portfolios of certain members of Congress. So to my mind, if I invest very actively, I pick active funds, then I would be more likely to try to exploit whatever information I have, even if it means leaking it to the portfolio managers. And actually, I mean, you have the data for it. So just out of curiosity, I took a look at this this guy Mark Udall that got into trouble back in 2007. That you show his holdings in the appendix of your paper, and so that's just roughly categorized. That's about his mix. So I was quite surprised. You could almost throw it to students as what's a good way to diversify. I mean, he's pretty conservative, like 30% is money market, but it doesn't seem excessively active. And if you look at his biggest holdings, I mean, these are like, you know, these are all like passive funds. So I don't know. In my book, he would not be likely to leak information, and then maybe he got into trouble for the wrong reasons. But perhaps that would, if you find that those guys that have a lot of active funds are also linked to this overweighting, that could be more circumstantial evidence. Briefly about omitted variables. So what I guess there could be more, but one that comes to my mind is just skill, that maybe members of Congress are just good at picking funds. So the question here would be, do their funds outperform overall? If not, that's actually good for you. It says that it's not, speaks against the omitted variable. And more specifically, like which funds in their portfolios outperform? Is it, and again, if it's those in which there is this overweighting phenomenon, that's again a little bit more of circumstantial evidence. Because it seems otherwise it seems a bit strange to jump straight to comparing performance within funds without looking at the fund performance itself. So I would say that's even abstracting from endogeneity for a second. And while we talk about this performance within funds, when I was reading the paper, I felt like your approach may be a bit too complicated. Like, so you have this weighting at the fund portfolio level, and then you have another weighting across funds. And I think I get the idea that you want to somehow replicate a portfolio of connected stocks using the sort of weights that the funds use. But given that it's based on pretty strong assumptions, like that funds only trade at the end of the quarter and so on, maybe something simpler like just using standard value weighted returns would work equally well. And I was also wondering if it's not just me, that's actually someone in the audience had the same question. I think it would be interesting to look at the contribution from these connected stocks to the fund's return, or raw return, or alpha. You could think about it different ways, and maybe even stratify it by the extent of overweighting. Like, do those stocks that are more overweighted contribute more to the return? I think that would be again another piece of this sort of circumstantial evidence around this information channel. So overall, I think it's a very good paper, should be published. And since there's no smoking gun, I think the way to go is to try to provide as many pieces of circumstantial evidence as possible. And believe me, I know very well how this can feel. So I wanted to leave you with something that will hopefully cheer you up. And hope you don't stop. With that, let's open up for questions, and maybe if you want to take a moment to
maybe first
to respond. So like I said, the thing about the contribution to fund return, that was also one of the questions. So if you could talk about that at some point, that would be great. All right.
First, I would like to thank Michael very much. Very thoughtful comments. I'm not going to defend myself now to waste time on that. You could see, yeah, it's true indeed. There's need to be done much more work on the causality. What could be one of the ways as well to check would be to see whether there was some death of politician or exile, whether they're going to be, or from the committee, whether they're going to be some changes. Or for example, if a politician switches from agricultural committee to energy, whether he's going to change the funds or the fund manager is going to change the holdings. So one of the other evidence. What, as you show the picture, yes, I need to continue and I need to go to the politician level. I especially appreciate comments also on the omitted variables, because and even you say maybe something is obvious, but I haven't seen it any of the discussions yet, like no one raised exactly that points. Really cool, thank you very much. So yeah, maybe some questions. We have 5 minutes. I don't hear you.
Yeah, what do you think about this? What is the percentage contribution of connected stocks to fund performance fund? I guess you
No,
don't have
it's a good measure. I didn't check it yet. What I agree completely with these weights, that if I want to support this hypothesis that politicians matter, I need to look at the both. That if a politician invests only in 2-3 funds, then he might be interested into sharing the information. If it's, as you said, diversified into 100 funds, then it's harder to argue that it's indeed the case. Would be the same, as you say, for the mutual fund. If it's a fund which has 1,000 clients, probably who cares? But here I'm a bit more skeptical. I think that nowadays it's so hard to get alpha that even mutual fund managers, not only hedge fund managers, start to dig, and it's easier with the big data now to see who invests into you. But I agree that there should be some incentive from the politician level to invest. And as you mentioned, and one of the, I don't know whose question it was, thank you, it's true that it would be interesting to see this added value to the alpha of the fund. Yes, right. And as you said, whether these mutual funds really getting higher returns on exactly this term holdings, yeah, that's true.
All right. So actually we have 2 more questions from Pramod Kumar, but maybe you want to unmute your mic and ask them yourself instead of having me read them out. So we have get more of a discussion going.
Maybe you just read them out.
Yeah, okay. Yes. So the second question was that if politicians and fund managers are geographically close, then that could also explain the overweight of connected stocks. So what's your thoughts on that?
Good point. It's possible that indeed that the social network, what I'm currently working on another project. I don't know whether I would be able to see where these politicians currently live and the managers. So I don't know whether it's good to try, but I'm not sure I would be able to do this, to be honest.
All right.
What I did, I know so far I collected the data also for the education, so where these politicians, to which universities they went. So probably I could go back to that paper by Cohen, which also looks at the links between CEOs and mutual fund managers. That's doable.
All right. And finally, the question was, do you see that funds change their weights in connected stocks when the politicians change their position in the stock? Which I guess sort of prerequisite is that they also hold the same stock individually.
Yes, I agree, but I didn't. In my paper, I didn't look at the direct holdings of the politicians. Maybe I could comment a bit more on the why actually politicians might use. Why would they go to mutual funds instead of just investing directly? Since we already have this question. There is mixed evidence in the literature. So some papers show that some politicians have skills, some of them show that they don't. So I argue that they need a middleman in order to do this. As I said before, they might also need them in order to hide the information. But again, it would be one of the channels, instead of going to whether they have the government contracts, to see whether they invest in the stocks, and what you told me as well before about the signaling strategy. Maybe I don't really need to see politicians who invest into me if I could observe actually how politicians invest. Why it would be not tradable strategy? I don't observe how politicians invest. It's not disclosed frequently, so there is a delay. And yes, if there are no more questions, I have one more question in chat actually. How you identify implicit or secret relationships of managers with politicians means how you capture that effect. I don't identify secret ones. I don't observe the one-to-one communications. What I do, I look at the direct holdings of the politicians into the mutual fund. So that's how I say that they're connected. It would be great to see whether they go to the same golf club, but I don't observe it currently. But thank you for the question. It was from Jamshed Ali. Yeah, thanks.
Okay. Yes, thank you very much.
Thank you again. I would like to thank all the participants. Thank you for joining, either from Europe or from the US. As I don't know, in Bergen it's really nice weather, so thank you for taking your time.
Right. And
thanks a lot. Bye.
Bye-bye.
And I may also remind you, last but not least, that we have another webinar next in 2 weeks. So don't miss our next webinar.